8 lessons that will help you reduce conflict and fireworks in your next valuation exercise. Hey, I'm Jawad, and today we're going to talk about valuation. Nothing causes more contention, more bad blood, and more fireworks than this little word. Let's see if we can shed some light on it. First, number one, the difference between price and value. They are not the same. Price refers to the point at which a transaction happens between a buyer and seller based on mutual consensus. Value is what something is truly worth. They're both open to discussion, to challenge, to debate, because they both depend on your outlook, your perspective, and your point of view. 2. What drives price and value? Buyers want to buy at a price which is below value, at a discount. Sellers want to sell at a price which is above value, at a premium. If you want a better price, get more buyers on the table and start early. If you only have a single buyer and are pressed for time, you're not going to get the price you want. Price is controlled by emotions and sentiments. Scarcity, fear, greed, the fear of missing out. This is a once in a lifetime, a once in a million opportunity. You're not going to see these price levels again. Have you heard that line? Of course you have. It's a standard toolkit in the toolbox of a good sales professional. Value is controlled by a different set of factors, the biggest of which is gravity. Gravity is just a fancy name for fair value, for relative value, or for mean reverting behavior. For any business, there's an underlying benchmark. Prices revolve around that benchmark. If they get too high, gravity pulls them down. If they get too low, gravity pulls them up. If you're a long-term buyer, player, or market participant, you don't care about prices on a specific transaction on a given day. You care about your average price across a given period. You don't worry about price levels on a specific transaction. You worry about staying in the game, participating in the flow. Let me give you a simple example. Is it possible for you to get a first-class airline ticket cheaper than economy? On most days of the year, the answer would be no. But just in case, if you found such a deal, would you buy it? The answer is yes, of course. It's a no-brainer. But as a frequent flyer, while I would really appreciate this deal, and it might even make my day on that specific day, what I really care about is my cost of travel across the full year. I don't care about the cost of a ticket on a given day. While I may be happy to pick this ticket up, what I really care about is my average cost across the year. So if prices are a little high today and I have to fly, does that mean I'm not going to buy a ticket and miss that flight? No. If I care too much about the price, then there's a reasonable chance that I'm going to miss the flight. And that's not good for investors or founders. Whether you're a founder or an investor, don't worry about the difference between price and valuation. Worry about staying in the game. Worry about participating in the flow. So where does this value/price comes from? Where's the engine that drives these numbers? When in doubt, remember 3 simple rules. Value comes from the difference between dollars coming in and dollars going out. If you grow the difference, you're more valuable. If you grow the rate at which this difference is growing, you're more valuable. If you can ensure, if you can guarantee that this difference, if you can prove that this difference between dollars coming in and dollars going out will keep on growing over a period of years, your value will keep on increasing. So the first 2 pieces, dollars coming in, dollars going out, and the rate of growth of this difference are easy to model and project. But the third, ensuring that the rate of this difference will keep on growing, or at least will be stable in the near term, mid-term, or the long term, is a lot more complicated. And it depends on market conditions, the structure of your industry, and your business model design. For you to build a good valuation model, it's really important that you understand these 3 aspects: industry structure, business model, and market condition. If before building the model you've understood them well, your models will flow well. If you haven't, your models will not go anywhere. A wise man once said, all businesses can be simplified down to a single equation. Make sure you understand what that equation is before you sit down and build a valuation model. Valuation and price estimates come from models. Models by definition are imperfect. They use incomplete information and are often based on assumptions that are likely to be proved invalid in the future. Much more than models, numbers, and valuations, transactions are driven by real people, by perception, by sentiment, by emotions. We often ask ourselves two questions before we buy anything. Question number one, is this something I must have or want? I call this the want test. If you answer yes to the want test, yes, I must have this, yes, I want this, you've passed the want test. Question number two, is this the right price point for me to buy? Would I look stupid if I buy it at this price? I call this the stupidity test. To pass the stupidity test, you must answer no. No, I will not look stupid if I buy at this price point. For a transaction to close, the buyer must feel comfortable with the results of both the tests, the want test and the stupidity test. To get a better price, you must increase the level of comfort of your buyers with both the tests. How do you increase this level of comfort? By using numbers to tell stories. Great stories make it easier for buyers to say yes to both the tests. If models by definition are imperfect, is there anything we can do to reduce the imperfection, the error in our answers? The answer is yes. Irrespective of the simplicity or complexity of your model, you can always test it. But don't just test assumptions. Test assumptions, test the business drivers, test the business model. Test a range of scenarios, test a range of outlooks. The objective of a model is not to give you one number. The objective of a model is to give you a range of values across a range of scenarios. Why a range? How do you build consensus? You don't build consensus by focusing on one single number. This is the right answer. That doesn't work. That doesn't work simply because there are no right answers. There's a range of answers. But it is far easier to build consensus on an outlook, on a scenario, than a given answer. If I come to you and say, do we agree, can we agree that the market is going to go north, that prices are going to rise? This is an outlook, this is a scenario. It's easier for us to agree on the scenario than saying, if the market goes up, price is going to be X. It's not enough to build a model and get to a price. It's also important to build consensus between the two parties on that price. Consensus begins with a starting point. Outlooks and scenarios make it possible for us to reach that point. So build models that give you a range of values for a range of outlooks and scenarios so that you find it easier for you to build consensus with your counterparties on the other side. Transactions are not driven by numbers, they're driven by relationship. Every time you close transactions, there are two possible results. You've generated positive goodwill or relationship capital as a result of that transaction. Or you've used up relationship capital. Either the buyer or the seller doesn't feel great about this transaction. Without that capital, building consensus is hard. Without consensus, closing transaction is harder. Consensus comes from trust. Trust comes from relationship. Trust that is generated, that accrues as you accrue relationship capital. So the question you have to ask yourself is, there's obviously going to be some give and take between price and value when you sit down on a transaction. So don't just focus on models, numbers, and valuation. Also focus on trust, consensus, and relationship. They're as much a part of the valuation process as the modeling exercises. So quick recap. 1. The difference between price and value. 2. Where do price and value come from? 3. Gravity and mean reverting behavior. 4. the value engine. 5 emotions, 6 model error, 7 relationships, and 8 consensus. Remember these 8 lessons to reduce the conflict and fireworks in your next valuation exercise. Thank you. This is Jawad Ahmed Fareed signing off for FinanceTrainingCourse.com.